this target that we get out of here is way up at $330 on a log scale chart, and then we see 600, and then we will see 4 digits. We've called for a single digit gold silver ratio in an overreaction moment period. That means 9.99 potentially or lower in gold silver. So you could have a situation where gold is 15,000, 25,000, and you could wherever it's going to be a very strong high, localized high, it could even be 108,000. That silver is 1/10, less than 1/10 of, more than 1/10, my apologies, of the gold price.
Silver also broke above the key level of $50, supported by tight supply. Spot silver hit a fresh record, boosted by both safe haven flows and industrial demand. As gold leads the precious metals rally, silver continues to attract buyers on dips, showing a strong correlation with gold's uptrend. As of mid-October 2025, the gold-silver ratio has fallen from over 100 to 1 earlier in the year to around 85 to 1, but it remains historically high. A further decrease would mean silver's price would increase relative to gold's. This is based on historical patterns where the ratio has tended to compress after reaching extremes. Market expert FrancisHunt, known as the Market Sniper, shares an exceptionally bullish view on silver. Using his HVF trading model, FrancisHunt projects silver could first pause around $330 per ounce before advancing into 4-digit territory. Hunt describes this as the biggest bullish setup of his career, one that traces its roots back to long-term patterns dating to the 1980 silver boom. From a technical perspective, Hunt envisions a future scenario where the gold-to-silver ratio collapses to single digits, possibly near 9 to 1. In such a phase, gold could climb above $25,000 per ounce, while silver could soar past $2,500, reflecting an unprecedented revaluation of the metal. However, Hunt cautions that such levels would likely mark a blow-off top, advising investors to begin taking profits once the ratio drops below 10. He further suggests that silver, due to its industrial importance, could eventually become restricted for retail ownership, with governments deeming it strategically critical, forcing it to trade primarily through industrial channels and causing bullion to command heavy premiums over spot prices. Before we dive into FrancisHunt's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
For the record, by the way, we have already said, not the high point, but that the silver price will have a resting point at $330, a significant resting point before going higher still. So there aren't too many people that come in with bigger numbers. We do see eventually 4 digits potential in silver when we get a gold-silver ratio that is lower. So our HVF method, which is a unique pattern, got us in before all the cup and handle callers. I'm just going to make this a quarterly chart because it's such a long duration. This is the biggest pattern of our favorite setup we've ever traded. And I've been in the markets for ages, by the way. This started in my childhood in the run-up to 1980, this setup. And that was our triggering point to go long right there. And you can see this is 3 months. That's a quarter. Each candle represents 1 quarter of a year. And this target that we get out of here is way up at $330. On a log scale chart, and then we see 600, and then we will see 4 digits. We've called for a single digit gold silver ratio in an overreaction moment period. That means 9.99 potentially or lower in gold silver. So you could have a situation where gold is 15,000, 25,000, and you could wherever it's going to be a very strong high, localized high, it could even be 108,000. That silver is 1/10, less than 1/10 of, more than 1/10, my apologies, of the gold price. So we think you'll have a moment. I don't think it stays there forever. You've got to have a point where you are getting out. You can't be such a bull and believer that it's forever only up. But when you drop below single digits in the gold-silver ratio, I'd certainly be selling off my silver. to some degree, at very minimum. And I think that's going to be a key moment. I'll reduce by more than half, and possibly even 3/4. But that's not anywhere near on the gold-silver ratio right now. Gold has had such a head start. We're still in the upper 70s on the gold-silver ratio. We need to see that break down, 30s. You'll have a pause at the 30s, the long historical 30s, and then you'll drop it further. So silver is just gold plus steroids and a turbocharger, basically, and a line of cocaine if you want, if that's your bag. It's not mine. But it's just the more extreme version, and it's got an incredible price projection future. And unobtainium, I think there'll come a point where it will be illegal for retail just for bullion purposes to buy. It will be deemed too strategically important, and it'll be industrially traded. And you'll sell your bullion for premiums to whatever the spot market is at some point in the future. The final point you made about Morgan Stanley and that allocation, the investment banking cartel, and they have been a cartel, are largely responsible for the fiat and debt debasement. They've worked hand in hand with state to bring this about. I'm quite contemptuous of their sudden virtue and their attempts to get in front of a narrative once clearly things are shifting in a market. What tends to happen is it's almost like, I use this rather, JP Morgan and Morgan Stanley, etc., all live in a communal home, and they've been defecating on the porch. And they are part and parcel of bringing the standard of living in the communal home immensely down. And then they run around to all the other commune members and go, hey, watch out, it stinks like hell out there. Don't sit out on the veranda, as if they're the warners. They got their losses socialized and their profits privatized in the events of subprime. And what people don't realize as part of CV19 is the Federal Reserve lent over 21 to 23 trillion to banks. Lent, we have no idea what those terms were, and those articles have been immensely suppressed. And for the Americans' ire, let me also add, some of the recipient banks weren't even American banks. They involved some Swiss banks and one or two others. So the Federal Reserve debased your dollar, increased debt, and created loans that probably can't be paid back, to make whole banks again with whatever derivative positions they had with regards to this ongoing Ponzi scheme. And what we're finally seeing is the cracks in the dam wall I was referencing, and far higher levels of water coming down the river. And we're the guys that want the water sports. We built our houses on the high ground. We want to fish again. We want otters and beavers and deer and everything to come and drink down there again. There are other people that built right by the riverbank on the basis that it would never flood. And what's happening is those that don't see gold are those people. They don't recognize sound money for what it is, are those that are right on the riverbanks that will be washed away. And those, you and I, are those on the higher lying areas, well away from the future flood, but are looking forward to being able to fish again. That we're starting to see them having to open all the sluice gates and some of the water coming over the rim. And yet the debt is continuing because you can't help it. You're borrowing to pay interest, continuing to be a parabola. So it's like all the glaciers upstream are melting, and not only are we flowing over the rim, but the volume of water is now coming so much faster. And that's what gold is showing. It's actually a great concern that we will be, a small group of very wealthy people in an environment where many will be deeply fiscally drowned.
During the interview, FrancisHunt predicts a major revaluation in precious metals with mining stocks, offering even greater upside than gold or silver. He argues that miners remain severely undervalued after years of neglect, while the fiat system unravels under mounting debt. As currencies lose purchasing power and gold prices climb, Hunt believes mining profits could surge, fueled by rising metal prices and lower operating costs amid economic slowdown. Gold producers demonstrated their typical amplified response to rising commodity prices, with major companies achieving gains exceeding 100%, while gold itself advanced approximately 60% during the same period. This leverage effect occurs because mining companies operate with relatively fixed production costs, meaning incremental revenue from higher gold prices flows directly to profit margins. The rally in gold miners falters narrative emerged after the sector reached unprecedented market capitalization levels, approaching $1 trillion, representing triple the 5-year average. This expansion reflected both higher share prices and increased investor enthusiasm for precious metals exposure through equity investments. Regarding the broader outlook, Hunt urges investors to measure wealth in ounces, not dollars, arguing that conventional accounting and valuations no longer hold meaning in a world of accelerating currency debasement. Let's get back to the interview.
Precious metals mining, I understand near the end of our chat, you're going to ask me to rate certain industries. And the only reason I won't give gold, silver, and platinum 100 out of 100 is I have to leave some space to put miners even beyond the metal itself. So, I'll be at 95 on silver, I'll be at 90 on gold, and I'll be at 95 on platinum, just so that I can say 100 or 99 on miners. And the reason for that is they have been greatly low for far longer even than the precious metals. So gold turned, you can argue, in 2000 in reality. Miners didn't really turn. Yes, they had a bump run in 2011 to the localized high of $1927 in gold, and then they came back even worse. They sold off even harder. So we've seen the market capitalization of miners to the point that they're so trivial of size and scale that the big fund managers and the trackers, they don't fall into any of those big funds. And what we've seen is the hyperscaling and hypermarket capitalizing of the surveillance state mechanism of the likes of Apple, Google, AI, meme amongst through all of them, etc. And we've got a saturation of capital in both the US in that specific venue and area for that side of things. Many of that development is highly speculative on how they'll get a return on AI, and we may well have to go through the dot-com boom and then bust cycle on. At the same time, you've got a crushed consumer, which is leading to very, and I've always said frame oil as the Rockefeller tax. When we were all houses were going up 15, 20% a year, 2005, 6, and 7. And we were all releasing equity and buying a new car every 18 months. Cabriolet this, cabriolet that, living the large old life. They put a higher Rockefeller tax on it. And we hit 150, almost 150 oil in 2007. Now, that started to put a lot of a strain. And when we had the subprime crash, we collapsed down into the 30s or even the mid-20s. And what's happened is that was a depression and we never fully recovered, which is why the oil price had to drop on the subsequent sell-offs even lower, which includes CV19, where we went zero. So think of it as a heat thermostat that is skimming when you're flush, and they're charging you a lot for heat in the apartment. But when everyone is crushed and doesn't have work or jobs, they lower it right down to avoid a complete collapse in other areas. Don't forget, they own both sides of the game. The central banks buying gold are the legacy families that own and are the shareholders of all the central banks. They own both the oil game, that's why I refer to it as the rocker, and the other. So the one hand takes a hit for the money to flow into the other hand. And what we're just having is, because of the consumer in the middle who's so crushed, we're going to have an extremity on the gold hand to the high side, and my other hand, which is right down there, that I'm tipping over. So when you have that understanding of framing, it's quite easy to see why inside the commodity groups, this is a theme. It is a reserve asset monetary theme based on the fact that the fiat debt debase system, point number one, is in collapse. Your dollar's buying power is the inverse parabola that you're seeing on gold when you look at the quarterly chart. And it's the same for the yen, it's the same for the pound. They all vary slightly, but they're all looking the same. So that is where we're at. I've got to refer back to your question because I think I've spoken around.
Well,
well,
I'm just hoping that folks are grabbing this because when it comes to the miners, because many
the miners. That's right.
many
the margins, they've got a parabola to the upside on their fiat-based gold price, which is the top line is doing that. And the bottom line, which is the cost line, is in a recession. And in actual, if you bear in mind that fiat is being debased as too, you have oil price going down. So we've called twice gold long, oil short. 2019 and again in 2024. Same technical pattern. I'll be showing it later. And it will go to a similar degree of extreme, in my opinion. And people are already trying to shake you out of your gold to get you to buy oil stocks or to get you to buy oil. And the point is, this is a secular reversal. And last time it ended in an absolute extremity. And they need those levels of extremity because people are such a large part of the population is just devastated by the oil cost. It's in everything, delivery, buying from Amazon. And so they really need to drop that cost and the heat they're putting through the sauna. So that because everybody's sweltering and falling like flies, right down and leave the door ajar. That's the reduction on the oil price to keep it. So we are in a worse economic shape. The main street, again, not the insider. There's a two-tier police system. There's a two-tier legal system. We're seeing communism, essentially, technological surveillance, communism being uploaded where there's a rule for me and a rule for thee. And they live by, we've got front running on Trump announcements, on crypto platforms, on Palantir contract awards, everything. It's a complete cacocracy. This isn't capitalism, but when it fails, they're going to blame it all on capitalism because the antithesis of capitalism is in fact what they want, the technological communism, Bolshevik communism. But what you actually have is a two-tier system where there is no justice for front running, insider trading, for anyone who's part of the political classes that think they're elite. And that's where we are right now. And we're going to be hated. I want to put out a few warnings. The people that invested early, you're going to be weaponized. The exact same gaslighting that occurred, and this is why I keep drawing parallel. We got 2 strikes for medical misinformation as a result of March, trying to save people. And I can tell you why you're going to first get these people did this to you, broke the system. Gold investors, silver investors, you're going to be told you broke the system and brought the fiat system down. They will reframe it. The people that defecated on the porch always try point fingers at the cleaners and the community members that were always doing the tidying up and trying to keep it in an orderly way. It is how it is. It is a great inversion perversion. And you might even find you should have your community and friends all around you so that you can be safe. And when amongst normies, and we have a phrase called nominal normies because everybody is thinking what an amazing stock market it is. The stock market and all other assets are really only moving up on account of fiat debasement. Your new benchmark, point number 4 on Francis's 4 points, is you measure your wealth in ounces of gold. There is no basis for accounting anymore. There is no fiat basis of accounting. You know, when you pay your taxes and you go and you have to tell how much revenue you made, and you said, I made $250,000 for the year and I had costs of 100. That basis of accounting is invalid. It's completely invalid and being debased at an escalating parabola to the downside. That is why gold is doing that. Gold actually holds its value. That's all it does. It doesn't have babies. It doesn't rust. It doesn't do anything. So what you're actually at is you're at the convexity, the steepening part of the curve of fiat debasement after the wall has held the water back for so long. And now it's flowing over the wall. All the sluice gates are fully open and the pressure is still building. The next thing is the wall bursts. That's you make your 80% in the 20% time that I've been referring.
Silver has demonstrated an impressive 76% year-to-date gain in 2025, building on an astonishing 168% increase from its 2022 levels. The decisive break above the psychological $50 barrier and its subsequent flirtation with a brief surpass of $54 is seen as a pivotal moment. The current rally is characterized by specific details that underscore its significance. With silver potentially heading toward triple or even four-digit prices, could we be witnessing the early stages of the greatest wealth transfer in modern history? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.